What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is September 6th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got a critical video for all of you out there who are watching both crypto, Bitcoin, and the broader stock market as a whole, because I want to spend some time to talk about a dynamic that no matter if you are bullish or bearish, you need to be made aware of here. And I don't see anyone really talking about this when it comes to the long-term dynamics that are changing beneath each of these markets. We've got a lot to unpack in today's video. This is going to be a really interesting one, so if you guys happen to enjoy it, consider dropping a like, consider subscribing as well. It's the greatest way you can support the channel and join the family. Now let's go ahead and kick off the rambling. All right, now I know a lot of you here are probably wondering what that dynamic is. What is this fundamental factor we need to understand? I want to go ahead and say something that might sound pretty outlandish at the beginning, but I'll spend some time to back it up here as we go throughout the video. What if I told you here today that one of the worst performing assets over the next couple years could be cryptocurrencies and the FAANG stocks, or the big technology companies? I'm talking about Facebook, Amazon, Netflix, Google, Microsoft, Apple, the huge technology companies that have made monstrous gains and outpaced the broader stock market. And along with that as well, cryptocurrencies. I'm talking about not only Bitcoin, but the broader altcoin space as well as a whole that used to make crazy, insane multiples. Well, I know that that might sound crazy, but I want to spend some time here to talk about why we need to understand that this could very well be a reality. I understand a lot of you might be eager to click off the video at this point. There are plenty of people out there telling you essentially that you just got a dollar cost average, that these assets are going to make the same kind of returns that they did over the last couple of years. And we'll just simply say that it's back to the normal in the next year or so. And this is, again, something, whether you're bullish or bearish, you have both people on both sides peddling this. Some people believe that Bitcoin's going to move lower. Some believe we're already set in our bear market bottom. But many of those people will still tell you that just DCA or DCA more aggressively lower in and get into crypto, and that's all you got to do. That's your ticket to becoming a millionaire. It's just accumulate Bitcoin at a lower price. Unfortunately, guys, this narrative, again, is still too optimistic here. It is assuming too many things. It's assuming that crypto is going to continue making massive multiples on its current market cap, that it has the same room of growth that it had over the last decade. It's assuming that liquidity is going to continue expanding here, and we're going to continue to see more capital, more credit in the economy over the next year or two, as most people have their time frame to accumulate or dollar cost average during that window of time. And the third element here people are assuming is that these investment vehicles, whether they be the big tech stocks, whether they be your favorite altcoin, or even Bitcoin as a more defensive play in crypto, are going to somehow be guaranteed to be the asset class that people want to invest in. Now, I understand why people feel that way. These were the best performing assets over the last decade. I mean, it doesn't take a genius to look back throughout Bitcoin's history and see just how much Bitcoin went up. And essentially speaking, when we would get bear markets, or even if you were to buy prior all-time highs, I mean, the price figure is a blip on the map compared to where Bitcoin is today. And that's why many people think that, buying into Apple, buying into Bitcoin, buying into these plays, there must be a guaranteed surefire way to make money over the next 5-10 years as the next best long-term bet. The unfortunate thing here is that at the end of the day, Bitcoin is not guaranteed to move up. I want to make that very clear here. Bitcoin as an asset could have very well set in its relative high or all-time highs for the next 5+ years. Don't think that that's crazy for a moment, guys. We're in an environment of contracting liquidity. We're in an environment where essentially crypto is struggling, more importantly, to find its value proposition after making huge gains. And on top of that as well, crypto, in order to accelerate from its current market cap of $1 trillion, is going to have a much more difficult time getting to $10 trillion than it did when it was at, say, a 100 billion market cap going towards $1 trillion, right? So it's important to understand you need much more liquidity, you need much more fundamental value creation in order to spur these bull markets. And as we emphasized here, we've got liquidity working against us here. The Fed alone is pulling back the balance sheet by about $100 billion each month. Global liquidity looks like it's ready for new lows, and the federal funds rate, when it's talking about the United States and other central banks as a whole, are starting to move to their highest levels since back in 2007 and similar levels we saw back in the early 90s or at the beginning of the acceleration in the 70s in order to tame inflation. Now, I understand some people have disagreeing opinions on when this is going to end. Some people believe it's next month. Some people believe it's over the next 2 or 3 years. Some believe we're going into a decade period of inflation. Either way here, even if we do start to see a reverse where we start to expand the balance sheet to some degree or interest rates start to decline, even with all of these potential scenarios, even the most optimistic one or the most bearish one, it does not mean that those assets that many people are dollar cost averaging into as if it's a guaranteed way to make money are going to be the best performing assets. Now, I'm not saying here that these assets are likely to not go up over time. There may be a very good chance that they still go up, right? And maybe they keep in line with the performance of the S&P 500. But let's just go ahead and I want to visualize why this is likely not going to be the case, that they're going to be the market leaders, and that it very well may be that we have a period of time where they go flat, where they don't really expand. Let's take a look at Apple here. Apple is the largest stock on the stock market. It is the most valuable individual asset outside of, government treasuries, any kind of thing like real estate. But when you're talking about a particular asset, Apple alone is a $3 trillion company. No one comes close other than our next candidate, Microsoft. But as you can see here, Apple, if we take a look at its market cap, is right about where it was back during the prior highs back in December of 2021. The reason for the slightly higher share price is because Apple is doing an extensive stock buyback program. Right? So essentially it's removing shares from the market. So essentially Apple needs to continuously get to a higher price in order to get back to the same valuation because it's consuming those shares utilizing cash from its operations. But I just want to go ahead here and talk about this. Let's put aside all the jargon. Apple's a $3 trillion company. For it to move up 100%, roughly speaking, right? If we exclude the slight divergence here for stock buybacks, essentially speaking, Apple needs to make, let's say over the next 5 years, to go from a $3 trillion to $6 trillion valuation, it needs to make a 100% move overall. It needs to double its valuation, right? That's a 100% move. And generally speaking, on an annualized basis, considering the effect of compound interest or the compound returns, we would need Apple to make a 15% return over the next couple years. Sounds pretty doable, right? Well, from a $3 trillion valuation to a $6 trillion valuation. Think about that for a moment. How massive $3 trillion is. How massive it is compared to the overall weight of the market cap in an environment where interest rates are at their highest levels we've seen since 2007, where global liquidity is contracting, and on top of that as well, the United States more specifically is contracting its liquidity. Right? So is Apple going to be in a position in order to do that? Some may say that liquidity is going to expand. Well, let's get back to the fundamentals. How is Apple going to essentially double its revenues and income over the next 5 years? Some may say the Apple Vision Pro will be the next big product like the AirPods or the iPhone. Some may say that Apple is going to be a big AI play, right? Or perhaps people just pay a higher multiple on the stock. These are the clear questions we need to ask here, guys, because none of those scenarios sound probable. For Apple to be able to take its current income, we take a look at the moment here. On a quarterly basis, Apple's bringing in about $20 billion. On an annualized basis here, or around $25 billion. Generally speaking, Apple's bringing in $100 billion in cash every single year. But that puts Apple as a company at a roughly 30 PE multiple. At the moment, around a 32-point PE multiple. Now, if you know anything about valuations, that's pretty high. And sure, Apple's got some serious moat. It's got a really dedicated fan base of consumers who love their products. But at the same time, it's already at a 32 PE multiple. So if Apple doesn't expand its income over the next couple of years and we double our valuation, right? This is, again, we need to have like 15% annualized returns at a minimum to really outpace the average returns of the S&P 500 and many other stock indices, right? So again, we either need to see one of three scenarios. We need to see Apple trading at a 60 PE multiple, twice the valuation premium it's getting paid at now. We either need to see Apple double its income, or we need to see some kind of hybrid of the two. We need to see Apple maybe go up to a 45 PE multiple and still be expanding its earnings, right? And sure, while some of those scenarios may sound probable to some, it is highly unlikely for Apple to continue doing that. It is incredibly difficult to go from a massive whopping $3 trillion market cap and the already existing market share it owns over equities towards a $6 trillion market cap where it's probably going to own even more of the NASDAQ, of the S&P 500, you name it. Take a look at Microsoft as well. Same exact scenario here because it's going through stock buybacks. Its market cap here is again right back where it was here, even though we're at a slightly kind of higher price, or we were back here back in mid-July. Put that aside though, right? We're at a roughly $2.5 trillion valuation here for Microsoft. In order for Microsoft to double, right, it's going to need those 15% annualized returns over the next 5 years in order to double its valuation towards $6 trillion, right? Excuse me, towards around $5 trillion. Think about it here. Microsoft has got a lot of solid businesses. It's got its cloud business. It's got obviously Microsoft Office 365. It's got obviously Windows and all kinds of different types of paths. It's got ChatGPT, OpenAI as its subsidiary, right? So essentially speaking, still, even with all of that already saturated in so many markets, what can Microsoft do to either double its income over the next couple of years to go from its current income potential on an annualized basis, which is sitting around $70 to $75 billion, roughly speaking, right? $750 million, let's give it that. And essentially going from that towards making $150 billion a year, or going somewhere in the middle, around $150 and $120 billion, and trading at a higher PE multiple from the existing one, which is already a 34 PE multiple. Take a look at the chart here, guys. And I want you to think about that for a moment and tell me whether or not you think that's realistic. And we can go through this time and time again and look at these companies and have the same exact scenario. If you already are aware, guys, these multiples that people are paying of 30 on many of these stocks, or in the case of stocks like Amazon, a 100 PE multiple, these are the valuations you pay for growth stocks. Stocks that are making huge beats on earnings, that are continuing to accelerate double-digit percentage points on a quarterly or annualized basis, and are really showcasing the steam that they're going to expand for the next 10 years and continue being dominant players. And while it may look like it's going to be an easy job for these companies to do that, when we consider the weight of market capitalization, currently at the moment, equities as a total in the United States are valued at roughly under $70 trillion. And when we understand that the market share between these six companies, Facebook, Amazon, Apple, Netflix, Microsoft, and Google, right, the big tech plays here that have been disruptors over the past decade, when they already own nearly more than 1/5 of the entire stock market, every single company you can think of that's public, they own more than 1/5 of that. Coming up close here, if we revisit back to the prior highs, coming up here towards potentially 23, 24, 25% in just six companies. How do they continue to expand beyond the broader equity market at a rapid pace? The unfortunate reality that I think many investors haven't faced and need to realize is that it's not a slam dunk guarantee that these companies are going to do the exact same thing they did over the last decade, and they are no longer going to have the room, the multiple room, in order to expand like they used to. Now, some of you are probably asking, and I understand this, some of you will be wondering, Nick, I don't care about Apple stock or Microsoft, I don't care about Netflix, Google, Amazon, or any of the stocks that you're mentioning. I care about Bitcoin. Well, Bitcoin at the end of the day suffers from the same dilemma. It doesn't matter if Bitcoin doesn't have earnings. It doesn't matter if Bitcoin has the halving event or a Bitcoin BlackRock ETF. Bitcoin made massive multiples. Those returns we saw over the last decade for Bitcoin, right? They come with an increased market cap and valuation and an increased supply of Bitcoin as well that contributes to that market capitalization. And right now, while we are at a discount from the prior highs at $1.15 trillion for Bitcoin, I think it was around 1.3 trillion at the absolute peak. Well, we're at 500 billion right now. I know a lot of people are saying, oh, that's more than a 50% discount. That's well beyond a 50% discount. I'm thinking about buying in. I want to go in. We're going to make new all-time highs. The halving event, yada, yada, yada. We need to come back to the reality here that this is a $500 billion asset. $500 billion, just Bitcoin alone. Crypto as a whole makes up another 50% of the market, at making it a total $1 trillion valuation at the moment. And we've got to seriously ask ourselves here, if we are really at a point where it makes sense to dollar cost average, and even if over the next couple of years, there is much more demand than supply in order to drive that valuation higher, right? Again, very easy for crypto, or in this case Bitcoin, to go from a $3 or $4 trillion market cap up towards a $300 billion market cap, right? Versus taking it here from $500 billion and doing another 100x multiple. Can Bitcoin really do that? Can it go from a $500 billion asset to a $50 trillion asset? Let's be reasonable here, guys, right? And I'm not saying that that's what people are telling you here, but you not only have to factor in for excessively diminishing returns, even if you are optimistic, but on top of that as well, if Bitcoin is going to struggle to get towards 1.5 or $2 trillion over some given window of time during the next bull market, it may very well be that Bitcoin is not your best bet, even in that optimistic scenario. My point here in all of this, guys, is to look for discounted plays, to look for small mid-cap plays that are showing signs of confidence, who have strong narratives, who have that potential at the end of the day to easily make 10, 20, 30, 40, 50, even 100x multiples. I know it sounds crazy, but there are opportunities out there. Unfortunately, some people are too pigeonholed on the crypto industry being where those opportunities are going to be because it's familiar, because it was where those market leaders were. It's because in many ways it was our first market where many of us made those sizable returns. But I gotta tell you guys here, take a look at the altcoin space, take a look at crypto, take a look at this relief rally we've had here that is fading sharply here over the past month and a half, and the inability to clear through prior resistance, which is now acting as multi-month resistance. Excuse me, it was prior support in the past, now acting as resistance. I think we've got to be honest with ourselves, guys, right? And at the end of the day here, I don't benefit. We have a main focus on crypto here, guys. I would love to tell you otherwise. But we not only have the weights of central banks across the globe contracting liquidity, and we have a weak fundamental narrative, but we also have a fundamental reality that I think many of us have not faced. That Bitcoin is no longer a small niche asset. It is a global asset. And being a global asset, it is not going to expand at the same rate it did in the past. Need I say more other than taking a look at gold? Need I say more than taking a look at gold? Gold still has not been able to clear after more than a decade since September 2011. It has not been able to sizably make any returns from its prior highs during the last bull run. Maybe that'll be subject to change here. However, when you account for global liquidity, you start to realize throughout the last decade that gold has underperformed the balance sheet by 50%. Talk about a store value or a hedge against inflation or money debasement. Gold didn't do that over the last decade. At the moment, when there was so much money being printed, it didn't show up to the plate. You've been much better off buying into the S&P 500, right? So this is my point here, that Bitcoin as an asymmetric asset is this kind of uncorrelated, non-government owned, limited supply asset. All these traits are really interesting and great, but there are periods of time where it may not produce the kind of returns people expect. And you have to be willing to stomach these windows of time. And you have to accept that if you're only focused on crypto, you're only going to get the opportunities and returns that crypto will offer at that given time, and you can't fight it. However, there is another path here. If you guys are interested in finding those market opportunities, doing the additional research and kind of looking into some alternative options in the market outside of crypto, there will be many sectors that I believe will outpace the balance sheet. And here on the Dash Report, our newsletter, we write here on the channel, each month we put out a 20-page plus report where we try to focus on those emerging sectors. This month, we just wrote on the 3 sectors we think are going to be market leaders in the next cycle. They've got the market cap potential, to the multiples expansion potential, along with that as well. They've got exciting narratives, they've got strong financials and strong growth metrics. And with these, they also are going to have the fundamental fabric to be able to actually play a role in the next bull market, to be able to outpace the broader stock market, or broader asset classes as a whole, if and when we start to see money printing and expansion of the money supply. Outside of the newsletter, you guys will get access to our trading alerts group. You'll get access to the discussion group. You'll get access to the blue-red line indicator we use for momentum here on the channel. So much more than the Dash Report. We've had a lot of people joining as a recent because there is really a solid offering here. And if you guys join on an annualized basis, you get 20% off on the newsletter. Above all, it's a great way where you can support the channel and get that additional 20-25% of content on top of what we produce here on the channel. If you're an avid viewer, I think it's going to be a great offering for many of you out there. And it is, again, a great way to support what we do here and all the free content that we put out here on this channel. But above all, guys, I hope, if anything, even if you don't sign up for the newsletter, that I provided some food for thought here. Essentially speaking, it is going to be really difficult for these companies to continue absorbing market share. They had a great run up here over the last decade during the secular bull run. But if we take a look back throughout history, if we take a look back at who the market leaders of the largest stocks were back in the early 2000s, in the 1990s, and the 1980s, you'll find that names like ExxonMobil or Cisco Systems that used to be the titans, or General Electric that used to be the leading companies, eventually started to falter. Because like all companies, you eventually hit your peak. You eventually hit the best times you're ever going to have. And for better or for worse, these companies slowly start to stagnate, die off, and not have the same kind of growth and fundamentals they used to have. It's just the reality of life. It's nature in the sense of the business cycle. And when it comes to the business cycle, that does have an impact on valuations. So, anyways, guys, I rambled on a good amount here today. If you enjoyed this video, consider dropping a like. It's a great way to support the channel. And I will see you guys on the next video on Friday. Take care, everyone.